Hello and welcome. My name is Hassan Askari and I'm part of the team which manages the Qatar FinTech Hub. We welcome you to the Angel Investment Masterclass, where we will be talking to a number of panelists and experts in the space of angel investment. I will now like to invite Mr. Mohammed Al-Imadi, who is the head of angel investment at QTB, and Mohammed is also responsible for developing the investment ecosystem in the state of Qatar. He's also a member of this investment committee at Qatar Business and Incubation Center. Over to you, Mohammed.
Thank you, Hassan. Good morning, good afternoon, and good evening to everyone, depending on where you are joining from. Welcome to the Qatar FinTech Hub Angel Investment Masterclass. So this Angel Investment Masterclass aims to increase the awareness of this topic and to bring the industry expert to share their experiences. Choosing this topic actually came from the importance of the angel investment subject in the entrepreneur ecosystem. So it's very important for our entrepreneur and the cohorts of the Qatar FinTech Hub, and also for our audience to get familiarized with this subject and to get also in touch with our industry expert to understand their perspective on the angel investments. So definitely the angel investment as a subject is important, as I mentioned, and it's also play a pivotal role on the startup and SME lifespan, as it acts as the bridge for the startups and the SMEs to the corporate investment world. In addition to that, actually, angel investment is not only about capital, it's also about the network, the experience, the mentorship, and the governance that the angel investors bring to the ecosystem. In 2019, it has been approved in the United States that more than 90% of the startups and the SMEs were funded by angel investors. And the same has also increased the survival rate by 4 years of the SMEs and the startups. So this also shows the importance of this category on funding the startups and the SMEs. So I wouldn't take long in the introduction and the statistics, because we are here today to hear from our industry experts and to learn from them about this subject. So I will also now chip into the objectives and the outcomes expected from this session. So the main objective of this session is definitely building the capacity of our current entrepreneur and the angel investors, and the people who wish to become the future angel investors. It's also important for us in Qatar FinTech Hub and Qatar Development Bank to build the database of the angel investors here, to be able to invite them to our virtual demo days, and also to give them access to our deal flow from different incubators and accelerators within Qatar Development Bank. It's also important, and this is something very important to our startups and our SME, to give them more access or further access to finance, if I may say. So this session will bring the angel investors to get familiarized with the Qatar FinTech Hub and other incubators and accelerators, and will give also our angel investors and the VC representatives who are attending this session an idea about our deal flow. And finally, on the longer run, in QDB and Qatar FinTech Hub, we are also aiming to increase the number of the angel investors in Qatar to support in building up the overall entrepreneurial ecosystem. So the agenda of today, as presented on the screen, we do have an impressive panel from industry experts, as I mentioned. So we'll be joined by my dear colleague and friend, Mr. Marwan, for the keynote speak, and then we'll have a workshop from Dr. Tejinder from 360 Nautica, and then we will also hear from two of our startups and SMEs. So I wouldn't take long. I want to hand it over now to Hilal to take you through the next step of the agenda. Thank you.
Thank you, Mohammed. Good afternoon, everyone. Brief introduction about Qatar FinTech Hub. It's a financial service industry for the state of Qatar. Financial services are expected to grow rapidly and represent a significant share of our GDP. The Qatar FinTech Hub is one of the many initiatives supporting the Qatar FinTech strategy, and it's aligned with the goal and objective for Qatar National Vision 2030. Qatar FinTech Hub, co-founded by Qatar Development Bank and established to support the growth of the fintech industry in Qatar, currently run 2 programs. Our aspiration is to become a globally recognized hub that connects like-minded hubs, organizations, and regulatories from across the world, and to be the forefront of the future of fintech. We aim to leverage fintechs to address pressing social and financial service challenges. The strategy is now live, with the FinTech Hub launching an incubator program for early stage startup and accelerator program for mature fintech. And we will focus on a key priority areas such as payment solution for SMEs, Islamic fintech, and regulatory technology. The strategy will also support the key initiatives such as regulatory sandbox, fintech license, and payment regulation to be launched by QCB. Commercial registration license are provided by KFC. As a part of the program, we are bringing together key local stakeholders, include government entities, banks, insurance firms, education providers, technology firms, mentors, and other partners under single platform. So the main objective that Qatar FinTech Hub can be summarized as follows: to enable Qatar vision and national initiatives by becoming fintech friendly, market attractive to fintechs to deliver on enterprise such as 2022 World Cup, TESMO, and support economic diversification. Maintain global competitiveness of Qatari financial services industry. Solve local and global challenges by leverage fintech. Finally, deliver meaningful solution to Qatari consumers. So as we can see in the next slide, the first wave of our program, we received more than 750 applications from 72 countries through bid days and select jury panel, and we shortlist 11 fintechs for incubator and 12 for accelerator, with together have valued over than 500 million US dollars. In second wave, our program, we received more than 550 applications from 55 countries. The number of applications was so robust despite narrowing down of the theme emerging technology and financial services. So since we started the program, we have held over 300 business development sessions with local and international financial institutions to aid collaboration between the fintechs and local system. Furthermore, every participating fintechs has been matched with mentor who will support them together in the program. The hub has a partner with a total of 32 institutions through MOUs to support hub's program efforts and overall Qatar fintech ecosystem. Out of the 32 partners, 11 are international and 21 are local and international financial service gates. The hub and our initiative have been featured in a number of media, local, international, include CNBC, Qatar TV, Gulf Times, and others. Our social media following has grown up by more than 1,400% in the last 10 months, and our webinars have attracted over 1,000 attendees. Thank you. Over to you, Hassan.
Assalamu alaikum. First, I would like to thank Qatar Development Bank and Qatar Financial Center FinTech Hub for this wonderful work that has been taking place over the past few years. It's quite an encouraging statistic and an encouraging vision for the future. I'd like to give you an idea about. Now, how do I have to get the next slide? Next one, please. So I'm gonna, effectively focus on how you should be attracting investors and what are some of the issues that can help you in putting together a successful business, and you get investors to be participating with you. Next slide, please. Initially, we really need to understand what is the global financial sector. I used to work for a bank, and it's always good to go back and look at it every now and then. When I was working there, the value of this market was closer to 17 trillion. Today, it is 26 trillion US dollars. This is a very, very large chunk of the economy of the globe. And a lot of this is very traditional banking services, lending, investment banking, payments, and various other tools that they use to generate revenue. The current disruption is focused on a few areas, which were mentioned in the FinTech Hub presentation as well. But this is my confirmation. It's still in payments, insurances, asset management, especially individual asset management, and wealth management, which is basically working with private banks. And wealth is usually somebody who has an income of more than $100,000 a year. All of the global fintech sector, all of it, including PayPal, is worth only $125 billion. We're not talking about valuations of those companies. We're talking about the economic value when it comes to the financial sector itself, including insurance. 75% of those are tiny, tiny, small startups. And this number includes the unicorns, which I only need to mention a few of, but PayPal is really the one that rings a bell. The fintech is driving financial inclusion and microfinance with focus on 1.7 billion people. While in Qatar here, we don't really have this problem, but if you were to look at a global perspective, there is unbanked population, according to the UN and the World Economic Forum, of around 1.7 billion people who have mobiles but don't have simple financial services. And those are the ones that are targeted by the new disruptive technologies that we are seeing emerging. Now, between those two, the financial sector used to believe that any fintech is something that needs to remain inside, something that needs to be protected, and something that should not be shared. Now, with the huge growth in technology and disruption, and the people like yourselves, the startups, banks and financial institutions are starting to look at you differently. And more, they are seeing you as an asset, as a good collaborating partner, in order for them to be able to maintain their market share and also grow by reducing some of their risks. Next slide, please. This is an area which I always like entrepreneurs to spend time on. And it is really the difference between what they call as behavioral economics and just standard economics, which is the stuff they teach us in school. According to economists, in the past, humans are pretty much static. They will only make decisions based on financial value. So they would go for a cheaper loan, or they would go for a cheaper house, or they would avoid a more expensive decision because at heart, they make decisions like economists do. But reality is different. And in the past 7 years to 10 years, there has been a huge shift in the thinking. And they are seeing the society as more of a psychological enemy, not an enemy, a psychological body that they need to deal with. So humans are dynamic, their decisions are not purely based on financials. They have other things in the back of their heads, depending on where they are and what they are doing, that helps them make decisions about their future interests in either transactions or in savings or in investments. That's why the social responsibility part of the startups needs to be closely understood from the entrepreneurs in the area they are trying to enter and to disrupt. Understanding the behavior of the society and also being close to the society and adding value. You need to be a partner with the society and not to think of them only as a valuable asset for your startup. Only when you start to think this way will the society see you as a good partner and a partner that brings value, improve their workspace, improve their lives, improve their access to products and services, where the banks have ignored them all of this time. And the moment you start to see them as humans rather than a number, they can appreciate this. And given the new tools in AI, a lot of the AI is being developed around those pillars: society, behavior, and value. And I don't want to give you too much input here, but there are many examples. Some of them are failures, some of them are successful. One of the examples is a company we basically invested in Sri Lanka that works with home-based businesses. And Sri Lanka, home-based businesses represent 70% of the economy. This is one of the most successful companies that manages loans that can reduce the cost of a loan to a bank, reduce their risk by understanding behavior, and extend the services, plus add a B2B e-commerce flavor to the Sri Lankan workforce, mainly at home. Next slide, please. The disruption and the key around innovation. We've seen a lot of things that remain in the hype area. So although blockchain is a big news item, we're only starting to believe in blockchain when we see countries implement them. And blockchain, we saw a huge bubble and a drop in this bubble, and anybody who puts a tweet, the value changes. So this is no store of value, but there is a regulatory negative comment about them, which we completely support. But we also see what China is doing, is they have now introduced it in a way that is strongly regulated and in a trusted manner. And we believe the future will continue to grow. And I believe in this region, including Qatar, there is a strategy that is being put in place by the Qatar Central Bank as per their own announcements, that they are putting something for the future. And inshallah, we will see this reality at some point. But all over the world, it's starting to take shape. So it used to be hype, it's good to know it. And as you grow into your business case, you need to think of those, and you need to think of them from a regulatory perspective, because the last thing you want to do is disrupt the regulator. You need to work with the regulator in a trusted fashion. And this is the second most important item, is trust. Trust between you and your own users and society, and trust between you and the banks and the regulators. And this is all the financial institutions or even insurance companies. And I keep showing trust in this presentation because anything you do, you need to gain the trust and you need to have their trust as well. Data and behavior, again, this is something we discussed in the earlier sessions. Banks for years have been trying to understand how to understand customer behaviors. And I believe they have failed in a big sense. I used to work for them and I still don't think they know. Looking at them from the top, no matter how big or how small they are, only startups are able to understand behavior because they are starting to take behavioral economics much more seriously. These are all young generations. We are talking about a generation that was raised online and wants to remain online and make money online. Data is, again, no longer something that only the banks have, user data specifically, or financial institutions have. It is now clear that we trust the internet much more than we trust the banks. although we put our money in the banks, but when we do our transactions online, we go on the internet. And our trust in the internet is based on our experience. So over 10,000 transactions, how many really did go wrong? And in reality, if you are careful, if you select those services carefully, your chances of going wrong is very, very low. So again, the social media platforms have now taken a trusted position. And we are seeing people and institutions starting to do transactions using social media. And the company I mentioned in Sri Lanka is completely based on Facebook. So all of the information they have is completely based on Facebook. They did not have to create their own data stores. They did not have to create their own platforms. They went and they used existing social media platforms. And I don't mean only Facebook, there could be many, but I'm just giving an example. And Facebook is starting to realize this, of course, especially after COVID. And they've invested heavily now in a business sensible environment that allows small businesses to have access and allow people to have access to those businesses. So either B2B or B2C with a payment system. The cooperative models is what I also want to emphasize on. It is important that, especially for you who are establishing here, is to work closely with the financial system and the regulator specifically. Although it is a little bit, some may say this is anti-innovation. In one sense it is, but it is also, you need to protect our economy. We don't want, to have examples of, Bitcoin failures that are in $2 billion in certain areas, including Japan and Turkey. So having our own regulation system that is extremely protective, we have a good policy in place, and we have extremely innovative technologies, but are not enough to access the new societal values. And I believe this is where the cooperation can take place. The central bank needs to be part of this, and the presence of QFC and the regulation also helps. So it is investments, but investments in, we wouldn't invest in a company that does not look into regulation seriously. Next slide, please. This is basically the steps we follow in our selection process. These are very standard. I'll go over them really quickly because I think I'm running out of time. But one of the most important things we focus on is the investors expect that there are cooperative models that are being put in place by those startups, and there is a global reach. So anything they do needs to have a global reach, especially those who establish themselves in Qatar, given that our market is small. But we are a great launchpad for technology that can then go abroad and obtain a much bigger value. The pitch delivery itself, and I don't mean, being dressed nicely. The guy from Sri Lanka who did Shop Up, I remember he did his presentation in his pajamas, and it was Ramadan, and the times were so different between us and Bangladesh, but it was not the look that we were looking for. We were looking at how much he knew what he was talking about and how much he handled the investors' questions. You need to be ready. The momentum and traction of your expertise, when you build those solutions, you need to have the right team with you and also the right level of growth. And that growth needs to be also realistic. And sometimes we see things that are not unrealistic, and we always look for expertise that can confirm those growth statistics. The market opportunity and size, of course, this is the customer base. And as I said, the bigger, the better, but you need to be realistic. The problem and the solution you are putting in place, and what needs to be, and what needs you are currently filling for the investors or for the users or for the businesses. The product that you are putting together, it's very important to understand how this product is and what it exactly does. And in many cases, we find it very difficult to understand the product. Sometimes it goes into too much detail, sometimes into too high details. We need to get it just right, and it needs to be combined with a business model. The business model is key for us to understand your revenue streams or your attraction of the users. How you approach the market, where you are targeting, and where you exactly you are going to see progress. And this is very important in the first year and a half, because that's really where we see success or failure. The team that you put together needs to be comprehensive, because we want to make sure that we're investing in a team that is investing their time, their energy, and they have the right brains, not just brains. They need to have also some evidence of previous success. It's very difficult to invest in a company for the first time. So if you have somebody with you that has been through a success or even a failure session, that would really help your team. It just grounds you down. Of course, the financials and understanding the competitions. And it's very important for you to explain to the investors where the money is going. So if you need $1 million, where are you going to spend it? And the last thing we want to hear is marketing. That's where we go wrong. Marketing is the last thing you want to spend money on. You need to spend your money in intellectual property or in people that are developing those intellectual properties. And that's really where we look. We as DTA are a seed pre-series A investor. So we don't invest in MVPs, but many others do, and we always cooperate with them. And we are very open to working with Qatar Financial Center FinTech Hub. And thank you. This is as far as I can go. I think there should be a next presenter.
Yeah, Marwan, just give us 1 second. I'm trying to reach the moderator. He's having an issue.
Oh.
Dr. Tajender, are you online?
Yes, I'm here.
Brilliant. So I think you can start. You're the next.
Really sorry, we had some audio issues at our end. So, Mr. Marwan, thank you so much for your talk. It was a pleasure listening to you. Mr. Marwan is a seasoned investor with a passion for business, startups, entrepreneurship, and technology. He's also a founding member of the Doha Tech Angels, an entity which provides seed funding for early stage disruptive technology startups in Qatar, the Middle East, and internationally. Thank you so much, and apologies for the technology goof up at our end. But I hope I'm audible now.
Yeah, you are audible.
Thank you. Next up, we have Dr. Tajender with us. Dr. Tajender Singh is a founder and seasoned investor in innumerable startups in Doha and abroad. Along with his entity, he'll be speaking about angel investing, the whole angel investing ecosystem, and about his platform 360 Nautica, which has been designed around it. Dr. Tajender has been responsible for inception and turnaround of many ventures and worked across industries in BPO, outsourcing, healthcare, e-government, ticketing, and among many others. So, Dr. Tajender, over to you. I'm giving you control of the screen. Please see if you can switch the slides yourself, or I'll do it for you, whatever works.
Yeah, I think I can do that. Yeah. All right. So thank you so much, and a very good afternoon to all the people who are listening right now, all the investors, startups, and anybody who is enthusiastic enough to be a part of this conversation. So a great welcome and a very good afternoon to everyone. Okay, so what I'm going to discuss is going to be centric around how you should be as an angel investor, what you should look at the startups, and what startups should feel when they are looking at the angel investors. So basically, they need to know. So there's a piece for everyone. So when it comes to the startup would see, okay, what exactly is an angel investor looking in us? You know, why and what we should pitch, what exactly he's looking in us, and how do we prepare ourselves when we come in front of the angel investors? Likewise, an angel investor, why in the first place who wants to be an angel investor, and why angel investment? Why not be a part of VC? Why not be going into mutual funds? Why not do some conventional investing? Why only angel investment? Why is it so attractive? Why it is a word that's been catching up so fast and so enthusiastically all across the various economies, and it has this particular segment of investment has developed and progressed a lot. So we'll see all those factors. So to begin with, what I'll do is I'll just give you a very quick brief of 360 Nautica that I'm a founder of. 360 Nautica is based and headquartered out of Qatar, Qatar Financial Center, and we coin ourselves as a startup for the starters. So basically, we are a venture building company who actually supports the startup in all possible ways in terms of investments and in cash, in kind, mentoring, coaching. The idea basically is in a bottom line is to handhold a startup and make it a commercially successful venture as far as it goes. So coming back to the subject, let us start from where the angel investment starts. Oh. Yeah. Okay, so let us start from where the angel investments begins. Now, angel investment basically has, and this is purely as per my personal experience, personal outlook towards the angel investment is to set the goals. When we set the goals, we will discuss about it. That what do we see when we set the goals? We pick up the good companies, we make good deals, we grow the good companies that we have done the deals with, and then we look at getting our investments back. Now, that is the life cycle of an angel investment. Now, when we do that, we predominantly look at a startup and we spend our time as an angel investor in three different things. So we look at the quality of the business, that how this business is and what is the quality of that. Is it being a professional? It looks like a professional startup, or does it look like a non-professional startup? The second is the market opportunity. Does this startup fits into the market opportunity? Does the market has that appetite to absorb this startup as an opportunity? And third, definitely, is the people or the founders, the characters of the entrepreneurs while they're building that startup. So these are the three elements that an angel would actually look into when he looks at the startup. Now, a very fundamental question: why be an angel investor? Now, there are so many. I've drawn a graph on the right-hand side which shows that you could be investing in the real estate, you could be investing in bonds, you could be investing in small caps, public stocks, private equity, venture capital. But angel investor, if you see, is on the topmost dot of the graph at the right-hand side, and this has the maximum return because you are investing in the darkest possible spot of the investment segment. So you are investing when the company is just a startup. You are investing when the company has not even, or the startup has not gone even commercial. So it is in the MVP, post MVP stage. It's in a POC stage, and this is where you are taking the maximum risk. So when you have the maximum risk, you are bound to, or you deserve to be a maximum return in terms of your investment. So the angel investment runs a maximum risk, but then also has an attraction to the maximum returns, which is much higher than even in the multiples, much higher than what a private equity or a small caps will do. So what are the 5 things? So I need to be starting from this point. So what we look at we look at setting up the goal. So the angel investor basically has to set a goal in terms of what kind of investments he wants to do, right? In terms of amount per company and how many companies. So the typical DNA of angel investment is that you invest smaller amounts in multiple number of companies. So you spread your investment to across 10, 15, 20 companies. Now this totally depends. There's no set formula to it, but this totally depends on an angel investor basically to look at and devise his own plan. But I would suggest that it should be spread across multiple companies, 10, 15, 20, and reduce your token, your amount to as small token as possible. So if you're investing, let's say $2 million across 10 companies, you're saying, okay, fine, I'm going to invest $200,000 each. So, and if 15 companies, I'm going to invest about $150,000 each. So spread it as far as possible in the lowest amount possible so that you spread your risk and you're able to, then mitigate your risk properly or handle your risk properly. The second point is pick up the good companies. Now, what happens in this is that when you look at the startups, there could be thousands of startups. I've just given a hypothetical number that if there were about 8,500 startup applications, 1,200 presentations, because when you filter the application, you will filter out almost 70% of not eligible even for the presentation. When you look at the presentations, there'll be probably 30% of them eligible for a due diligence. And finally, there could be a funnel of 2 to 3% or maybe 4% on the higher side, which could be funded, which could actually look as good companies, good startups, or the promising ideas. So that's where actually, this is how fundamentally a VC or an angel investment segments work. So when we are doing the due diligence, basically, let me just highlight that. When we're doing the due diligence, we have to put percentages on certain segments. So I've identified 6 different segments that we should always look at: management team, size of opportunity in the market, product and technology that the startup is offering, sales channel, how they're going to sell their product, are they very strong on that, need for more funding in the future, when exactly is that? Because you have to also assess that you are not the last investor. So if they're able to raise funds more in the future, then only we are secure. If they're not able to raise the funds in the future, then probably they will sink with your investment. And then could be the other factors. So basically you make weightages around it. For me, the management team is the maximum, which is 30%. I would invest, give a weightage of 30% to the management team. I will give a weightage of 25% to, let's say, size of opportunity in the market, followed by product technology 15%, sales 10%, need for more funding 5%, and miscellaneous is 5%. So this is hypothetically a distribution that I have done it based on my experience and the way I deal with the due diligence in the startups. So the third point is making the good deals. When you have reached out to that last 3 or 4%, now you are looking at making good deals. You're looking at how can I maximize my investment return by a small ticket of investment. So you are looking at, let's say, the $50,000 investment into a startup. Now you see, out of that $50,000, how can I negotiate on the valuation of the company, bring it down, and what would be the deal structure, how I will do the valuation of the company, can I negotiate on that? We have to look into the term sheet conditions, that am I getting, how I'm getting exit. It is, there are certain technical, things that you have to look on. For example, I'll tell you, it's a drag along, tag in that, which means that when the other investor will exit, I will also have an exit. Or with other further future dilutions, I can make a dilution with the dilutions of the founders. So you have to technically understand the term sheet, that how am I secured as an angel investor? Can I be making an exit on my own out of this, or I make an exit when others make an exit? What is the valuation of the company? Can I negotiate the value? Is the valuation of the company on a certain logic, on a certain basis, or is it something that is just out of the gut feeling, and then I need to negotiate on that, and then how the deal structure is? So all of these 3 aspects have to be carefully understood, carefully mapped when you're making a good deal. So when you're doing the deal structure, what exactly are you buying? Are you buying common shares? Are you buying preferred shares? What is that founders are offering you? So most of the startups I've seen these days, they're offering safe notes, they're offering convertible notes, which is something that is the future shareholding for the angel industry. So this is a very normal, it's a normal nomenclature that is happening these days, but that is fine, but it's just about an awareness that you should know that, are you getting into the right shareholding as a common shares, or you're going to get into a safe notes or convertible debentures? Because every single a type of share or a debenture has a different way of exit. So this will actually determine your exit or the future existence in the company or the returns of the company. So this is a very important piece in the whole deal structure, to understand that what exactly are you buying. Going to the next one, this is one of the again most very important point, that what are you paying to buy this? So what is the valuation of the company? So there could be a startup who would say, I'm valued at $3 million. Now what is the basis of $3 million? Is it based on the revenue? Is it based on EBITDA? Is it based on multiples that exist in the market? All of that, and you have to understand that how sound is an idea when you are doing a valuation based on some numbers, which is a revenue or EBITDA or multiple X existing in the market, trending in the market. But you also look at the factors that how sound is an idea, that when you're over, you are buying a valuation at a premium. So is that idea something that is irresistible, something that's going to change the market? Is it a disruptive idea? The prototypes are patented, they are trademarked, they are secured. How is the quality management within the organization, within the startup, the strategic relationship the startup has with various the part of the ecosystem of the business. So all of those factors, I think you have to keep in mind while you're dealing with that company in terms of its valuation. So that's again a very important factor. Okay, that brings me to the fourth point, that when you have invested into those companies now, so we call them as good companies. So let's say you've invested into 2 startups. Out of all the presentations and due diligence you had done, you finally decided that I'm going to invest in 2 companies, $50,000 each. And for you now, those are the good companies. So you have already invested in that. You are past that stage of investment, getting your safe notes or your shares or whatever way you have been engaged, and your investment has been secured. Now we call them as good companies. So the investments that you have done are known as good companies. How do you grow them? Right? So you need to contribute and you need to be part of those companies as an angel investor in terms of their governance, in terms of their metrics, in terms of money that they need at each stage, and also help them in raise the future funds. Extend your network connections in terms of interactions, relationship across the banks, across various corporates to make the startup grow. So if you don't put your contribution into the startup, you're not doing justification for the investments that you have done. So it's very, very important for you to contribute into the growth of the good companies that you have invested in. If you look at a typical ROI, on the left-hand side, I've made some bar diagrams which shows that if a typical angel investor has spent about 1 or 2 times in a year, his investments could multiply or could be at 1.3x over a couple of years time, compared to if he does it 1 to 2 times a month as an angel investor, his investments could be 3x, 3.7x in terms of value. This is very indicative as far as industry standards are concerned, but this may not be a very accurate numbers. But yes, of course, what it is trying to say over here is that the more time we spend on the startup on a monthly basis as an angel investor helps the startup to grow as a good company, as a venture. And then, of course, it becomes a better ROI company, ROI startup for everyone, including the angel investor himself. All right, getting your investment back. So we are on to the 5th point, which is the most important point. This is the milestone 5, which we started the angel investment. Why we looked at the startup, why we became an angel investor, why we invested, why we did the due diligence, why we actually went through all the cycle of taking that huge race, supporting the good companies, identifying due diligence, investments, holding on to the shares or safe notes. So the idea is to get an investment back. Now, there are various ways of getting the investment back. There are 3 ways the investment back. One is taking the company public. So you're helping the company to go to the point where the company can become public IPO, which could take a larger number of years, but yes, of course, the returns will be much more bigger. So some of the companies in US, they start from the startup in the Silicon Valley, end up getting listed on the stock markets, and this is where the angel investor, when they make an exit, they make massive multiples of their investment. So this is where the real returns are. The second is when the company is sold to a bigger company. So these kind of examples we have seen in the Middle East, in the region. We have seen Kareem, we have seen Souq.com being acquired by Amazon and Talabat. And so we have seen all those examples of smaller companies getting bought by the bigger ones. And this is where the angel investors have exited by making some nice multiples on their investments. The third is when the company buys back the shares of the loan. So there could be a stage where the company makes a lot of profit and the founders think that, okay, fine, they need to regain their shares, and they buy out the angels. And this is the third and the last exit that the angels can make as far as their investment is concerned. And if an angel investor is not able to make exit out of these 3, then 4th is where he's walking dead, as I wrote zombies. So basically you need to ensure that you are in the first 3 as an angel investor. You can't be sitting there and, waiting for investment infinitely to return. But if that happens, that means there is something wrong with the startup as a choice or as a performance, or the company hasn't been able to perform as you expected. So yeah, so this is the nutshell of what we look at when we get back, when we look at all the 5 steps. This is doesn't seem to be moving. Yeah. So yes, so this brings me to the conclusion of the ideas that I wanted to share with you from the angel investor standpoint, that we invest in founders, not just the ideas. So the startup basically is a sum up of a great idea that is an excellent market opportunity, and has an excellent founders backing that up in terms of idea and making it a reality into a commercially successful venture. And as an angel investor, when we see this, we are very excited, and we get excited. We invest into it. We support them as in cash and in kind, and this is where the game changing happens. So this is it from my side, and I'm open to the question. Thank you very much, everyone.
Thank you, Dr. Tejinder. I think it was really insightful session for both the early stage investors, and I'm pretty sure that most of the startups must have also gotten some insight around how angel investors actually think. Thank you so much once again. To the audience, the next that we have is a very interesting session. It's a fireside chat that covers both demand and supply side in the angel investment ecosystem. From the startup side, we have Mr. Abdullah Sumro. He is leading My Book Qatar. It's a QFTH Wave 1 fintech and one of the leading providers of digital app-based incentives with a network of more than 1,000 locations across every category. On the other side, we have Mr. Panagiotis Kerasis. He's head of business development at Anzar. He brings expertise from senior leadership roles that combine financial services and banking with fintech, payments, e-commerce, and digital projects. Over to you, Abdullah and Panagiotis for the session. Thank you so much for joining in.
Thank you very much, Sachin, for the introduction. So let's, wait, do we have Panagiotis? Okay, I think we'll,
we might have to wait a couple of minutes. Probably he might have just dropped off. Just allow us a minute.
Perfect. Yeah. Perfect. Great. So, but thank you so much for the introduction. And I think this is a much needed session. So as more startups or more founders who are aspiring to start startups, you know, the number is increasing, and the angel investing is becoming more and more important. So this, I think, is a very critical session, this masterclass class that we have had today. So looking forward to having a conversation with Panagiotis on this. So while we wait for him, so a quick summary of what we are going to do. So it's going to be a free flowing, chat where we'll talk about what angel investing is, how you can find the right angel investors, and how you can basically attract investment that you need to jumpstart your, startup. So, and feel free to post any questions that you want answered during the session. So as I said, it's going to be a chat and less of a formal session.
Also, one quick request to all the audience, in case you have any questions, because just after the session, we'd be having an open Q&A for all the speakers we had so far. So you can type in your questions right away, even now, and we'll try and pick up the correct speaker and try and answer as much questions as possible for you. Mr. Panagiotis is joining any minute now. He dropped off due to some technical glitch. Hi, Panagiotis. We are up for the session. Already Abdullah is on the call, and over to you, Abdullah.
Thank you. Are you there, Panagiotis?
Yes, I'm here. I can hear you.
Wonderful. Thank you. Thank you. Great. So, I gave a quick introduction of what we're going to do. So I just said we'll be having a chat, more of a chat on what angel investing is, and by the time our listeners they leave the session, they'll hopefully learn something new about angel investing. So let's start. So I think the first question that I would like to start with, something that's very basic. If we can, define for everyone what angel investing is and what's the role angel investors play in the startup ecosystem, especially, one like Qatar, where we are seeing increasing startup activity now.
Yeah, I mean that's a good question, and that's a basic one. And I would say that angel investors are, I mean, they are known under different names. So, for example, private investors or seed investors or informal investors. Most of the times, not most of the times, I think I would say 99%, we talk about individuals that are supporting startups on the early phase, and they're basically looking for better returns. So there's a combination. I mean, on the one hand side, we have the startups. They're looking for funds, for financing in the early stage. This is not to be found through lending. So the idea here is that you have investors, private ones, who are willing to take additional higher risk. Let's put it like this. And they are investing in startups in exchange for equity most of the times. So they and they are taking a significant risk in exchange for a return in the near to medium future.
Great. Thank you so much. So I'll just add to what you said. You're very right that these are, I would say, early investors, or maybe they are successful individuals or entrepreneurs who might not be, sort of registered as sort of a VC is, who has, sort of much more sort of bigger funds, and they invest funds from their partners as well. So I think you're very right. They take on more risk. And so one, I think, important point that I want to highlight here is angel investors perhaps also includes, your friends and family. So these are people that you would reach out to. So this is a stage where I would say a lot of the startups might not even have a full-fledged product. So you need to reach out to people who would trust you as a person. They would have confidence in your ability to execute that startup. So you're very right. These are people who take more risk, and they would perhaps focus more on the founder than the sort of I would say the startup or the idea they're sort of pursuing. So this would include friends and family. And here I just quote my example as well. When I was founding my last startup, so the first person to give me a check was actually a friend who did not ask anything and just transfer the money, which enabled our initial team to get the MVP out, and then subsequently go to a bigger investor. So from that perspective, that's very sort of important. So another quick point, if I may add to what you said, is a lot of these individuals also get together to create an angel club, you can say, or an angel group, and it's important to sort of highlight it, because just before this session, we had Dr. Tejinder, and before that we had, Mr. Marwan. So Mr. Marwan in Qatar has, sort of Doha Tech Angels, which is, from my understanding, a club, where multiple angel investors are coming together. So now moving on, as an angel investor, so we know they put in money, but in addition to money, is there anything that they put into the startup? What sort of support they bring into the startup in addition to putting in money?
Yeah, so I think that's a good point. And actually, just going one step back, we need to differentiate. So we need to focus on the fact that these are early stage investors. Most of the times, they are not so much involved in the day-to-day business versus, let's say, when you have a VC, for example, a venture capital, they tend to be much more active, and they also tend to be investing a bit later down the road. So there is also, let's say, a turnover factor here. So I would say that in most cases that the angel investors are not day-to-day versus the VCs, where they normally take a seat in the board at least, and they want to have a say in the business. But we can also find in angel investors, I think we can find different kind of situations and different roles. I would say that certainly because of the fact that we do find investors from different backgrounds, sometimes it can be from within the business or within the business segment that the startup is trying to attack. So I think the contacts, facilitating with contacts is one. Advice is the second. But there is one critical point here, and most of the times, as you said, so there is one element that is trust. So basically, they look at the founders, at the team, at their ability to execute, at the, let's say, go-to-market strategy and the product that they have. And on the other hand side, they're trying to help as much as they can in terms of advice. But I wouldn't say that they're in most cases so much involved in the day-to-day business, because one of the basic elements of an angel investor looking at the startup is basically a solid founding team that can execute. So, and this is the element of trust that you mentioned. So if I'm investing my money, and this is personal money, by the way, so this is not, I mean, versus a VC, here I'm investing my personal wealth. So I'm taking the risk with my own property, my own funds, and I'm not managing somebody else's funds. And that's a crucial, that makes a difference. So I have to have confidence in the persons, in the founders running the business. And that's why I think that's one differentiating factor why they are not so much involved. On the other hand side, for example, if you go to family and friends, many times, as you said in your case, it might be the case that they are not in a position to help because they might not be in the business, they might not have familiar background, so it depends. Or if, for example, if we go to crowdfunding, which is also an alternative means of angel funding, it's necessarily not the case that you get advice or you get anything else apart from funding in this case. So I would say that there is a tendency to have a light involvement, but again, on a case-by-case basis, you might find different applications and scenarios.
Great, thank you so much. I sort of agree with you that these angel investors, they're not involved day to day, but they do play an important role in pushing the startups, forward by perhaps playing different roles. As you said, an advisor, they can advise, and there are a number of things I've seen. If you have a very active angel investor who's well connected, they can help you with your next fundraising round. And if they trust you, if they know the ability of your ability and the ability of the team to execute, they will sort of help you connect with more investors for the next round. Their advice would be the key. So I think, if I take away one thing, is that you need to find people who would sort of fit into your, business vertical and your individual requirements. So you sort of bring these angel investors on board who can sort of help you push forward. So now in connection to that, so we know who these angel investors are. We know how they can help you, and they are very critical at the early stage of the company when you're just sort of starting out. So for a founder, what is the right time to go to angel investors? And so if I'm a founder, so I say, okay, this is something that I want to sort of build. So is this the right time to go and sort of approach angel investors? And then again, it's a whole science, and how do you identify the angel investors? How do you approach them and all? But what would be the right time to get to these early stage investors?
That's a very good question, and actually it's a question that I hear very often. So what is the right time, as you said? And I would say that there is no right or wrong time. I mean, for me, you have companies and especially startups, they have different life cycles. So for example, you can be in a different stage of the life cycle of the company. It can be early stage, it can be late stage. And of course, the different life cycles, they come also with different requirements in terms of traction, in terms of product validation. So for me, there is no right moment. Depends on what exactly is that what the company needs. and how carefully you are selecting what you need. For example, it can be the case that you are in an early stage, you have a product which is not validated, and you want, for example, funds so that you can validate the product, meaning that the valuation also is lower. So the risk that the angel investor is taking is much more significant. Or it can be the case that you are at a later stage of the startup, you have a validated product, you have some kind of traction, you have some successes in terms of having some clients that you can show. And this is also where you can ask for money, most likely with a higher valuation. So I would say that in all kind of stages, you might be asking for investment. You might be looking for people, for angel investors. But it's probably on a case by case basis. So it depends on the needs. One thing that I think it makes sense, and I would advise everybody to do, irrespective of the timing that you think is right for you to search funds, I would say that you have to prepare in advance. So you have to kind of network, and you have to start looking for investors before you need them. So, because I mean, by the day that you will need them, you will not have enough time to find the right investor, to do the research, and to actually find somebody who's going to believe in what you're doing and be able to put funds on the table for you. So I would say, if there are two things to take away based from my experience, one is that look as early as possible. And second of all, there is no right or wrong time, but it's connected to the needs, to how the company is going, and to how you think that you are going to be able to use the funds and go to the next step.
Perfect. I sort of understand your point. So just as a follow-up, so you write that there is no right or wrong time. And I think it may depend on who you are as a person. So for example, if I'm a first-time founder, so perhaps the angel investor, or any prospective, sort of investors who I might not have a close connection with. So they might be skeptical of investing in me. But if without a product, without a validated product that you sort of highlighted, sort of a late stage, I have a validated product and then I'm going to raise money. So perhaps, for me as a first-time founder, it'll be easier if I have a validated product and then I go to angel investors. And if I don't have even that money and I cannot bootstrap, so perhaps I should look to friends and family for that fund and then have a validated product and then go to sort of investors. In the other case, where you might have a successful track record of working at multiple startups, or generally you have had relevant experience, then you're right, you could be at a very early stage and you might not have an MVP even. You might be able to raise funds. So this is what we have seen in the MENA region as well, that founders who have worked at Kareem, for example, before starting out, or at other successful startups, they were able to raise good amounts of money at a very sort of early stage, but they have a track record to to strengthen their position. Now, moving on. So for any early stage founder, and what are the things that an angel investor, again, it's different from a VC, but an angel investor, they would look for in founders who are going for the funding. So this is something that was also covered by Dr. Tejendra Singh earlier, who talked about, he said the most important one is the team and then the market side. And there were other factors, but team and market were the key factors. But in your opinion, what is it that angel investors look for in founders looking to raise money?
You did mention two of the important aspects. So the team, the founders, so it makes a difference who you are, what is your background. As you said, it can be the case that in some cases we see this. I don't think that this is necessarily a criterion, but we do see that, for example, there is a tendency to invest in startups which can showcase the founders' previous successful experience. So definitely the team and the founders. Some kind of proof of how well you can execute. That's important, and this is going back to the question if you have if you can showcase a couple of successful exits, for example, before. And additional two things, and I think I touched base a bit previously. So one has to do with the product, not necessarily a product that is, let's say, state of the art and is 100% ready, because this is never going to be the case. But the validated product, I would say, makes a difference. And also something which I call traction and a go-to-market strategy. Traction meaning that I have a product, but I have tested the product and I have some successful clients that I can that I have convinced, I have managed to convince, and I go to my investors and I say, look, this is my product, this is my idea, but it's not only an idea, because I have some clients, early adopters, that believe in this, and they are actually now my clients. I think so. This is what we kind of call traction. This is one of the most important convincing points for somebody to invest on the one hand side. And the other thing is, okay, you have a product, you have traction, you have a good team. What is your go-to-market strategy? So normally, when I don't see a go-to-market strategy, which is again connected with the market and the potential, that's a very serious flaw. Because at the end of the day, you have an investor. He's taking a significant, or she's taking significant risk, and the expectation is always that I have a 5 times, 10 times return on my money at some point in the medium term. So if I don't have a go-to-market strategy that resonates at least with a specific market segment, it's difficult to convince somebody. And I would say, if I have to kind of, let's say, make a comparison between the importance of the product or the go-to-market strategy, that I've seen more successful startups having a better go-to-market strategy combined with a not so well fine-tuned product than the opposite. So having a very good product but not a good market strategy, I would say, stands more chances of failure than the opposite, because at the end of the day, it is what you are able to sell and how you can market your product on the market.
Mm-hmm. No, interesting. I think you've made a very important point that you don't need to have a perfect product. What you need to have is a good market, and there should be something that you can go out there and sell, and then with time and with his speed, you sort of iterate on that product. So I think it all comes down to what we talked about earlier is a good team and a good set of founders who are able to execute on their plan, on their go-to-market strategy. So that's a very sort of pertinent point. So in this sort of you sort of highlighted one or two mistakes that founders commit, or I would say red flags that are there. So in addition to it, are there any other mistakes that you see founders make when approaching or when pitching to these angel investors?
One very common mistake, I think, is not knowing your stuff. So for example, I have not researched as much as I should. So I don't know my stuff. I don't know my market. So that's one. The second thing is that I don't believe enough in what I want to do. And if I'm not, and I should be this person, because if I'm not alone, I'm not able to showcase that I'm passionate about what I want to do, then nobody else is going to support this. So I've seen kind of, let's say, both scenarios, both cases, having people that they are either not very much knowledgeable on what they want to do, on the product, they are not aware of their KPIs, of their metrics. So that these are things that it goes without saying that they should be coming as a starting point, and the rest will follow.
Mm-hmm. Perfect. No, I agree with you, and I think one of the things that potential founders can perhaps do is, so when you're approaching any investor, there are certain things that investors look at, and founders, and I've seen this personally as well, and have made mistakes, and so perhaps it would be useful to take maybe a good course on sort of angel investment, or any fundraising for that matter, which is given by an expert, an angel investor or a VC himself. So that perhaps, would help founders to see how to actually present the case, how to, avoid these mistakes. So I think a small investment could go a long way in ensuring that you are putting your best foot forward, and you sort of know how to go about, sort of raising funding. So that could be one good investment that of time and maybe money that one can, sort of do. Now, so we've spoken about, who angel investors are, how to sort of approach them, how to sort of pitch them, what are the mistakes, and what all they look for. Now, if we go a step further and see, and again, this is a, sort of the angel investment. There are multiple, sort of aspects to it. There is a whole process, and we can go on and on. But in order to keep it sort of within the limits of time, so let's go and talk about once you've received the funding, from one or more angel investors, how can a founder ensure that they get most out of this relationship, given that they have selected the right angel investors for their startup and for their specific, context?
I think it goes back to being very clear at the beginning about the relationship and setting the expectations from the outset. And that's something that is not necessarily done always. So when you're looking at an investor, on the one hand side, you as a founder, you have a certain kind of, let's say, expectation or need in terms of what you want to have. So on the one hand side, it's funds, of course, but it might be that you're looking for connections, it might be that you're looking for advice, or it might be that you're looking to penetrate a specific segment that is not, let's say, it's not coming with open doors for you. And the investor, on the other hand, you might have different kinds of investors. So you might have somebody who knows the segment or who doesn't know the segment. So I think that it makes a lot of sense if you have an open discussion around the expectations on both sides, so that you can also define what are the next steps and what is the timeline against which you are playing. And what I always say is that it's much better if you are under-promising and over-delivering, because this is also creating, let's say, a very good basis for the next step, rather than the opposite. So for me, that's key, and I think you may find a lot of variations, let's say, in a lot of combinations in terms of these factors that I mentioned. But at the end of the day, every relationship is different. It has a lot to do with the chemistry, but also it has a lot to do with setting up from scratch, from the beginning, the right base, the sound base for the next steps.
Great, thank you. And so something relevant or as a follow-up to what you said, and this is something that was highlighted by in the last couple of presentations that we've seen, is angel investors themselves. There are certain angel investors who are more hands-on, and they may be giving they may be engaging with the startups on weekly or monthly or maybe on daily basis, depending on the relationship, because at times angel investors also come in as technical experts, or they might be bringing in domain expertise in which the startup is. So you're right, that this should be discussed between both the startups and the investors to set the right expectations upfront, and then whatever the expectation and commitments have been made, and then I believe it sort of depends on the founder, and it is important for the founder to keep investors updated on regular basis and keep them excited. I think it's very important to keep investors excited and sort of abreast of what all is happening, and this may bring up opportunities where they can add more value. So now just moving to last couple of questions. Now, since we're part of Qatar FinTech Hub, and fintech is a very sort of growing area, and we are seeing that the investment into fintech startups has grown significantly in the region. So do you have any specific advice for early stage fintech companies or aspiring sort of founders looking to get into investment, looking to get into fintech space as far as angel investment is concerned?
I would say that the advice I have coming from experience is not only applicable to fintech, but is a more generic one. So I would say it goes back to the basics, and it goes back to being in a position to define the problem. So and do it very simply. So you should be in a position to explain the problem that you are solving in a matter of in a minute, let's say. So that's one thing, which is showcasing your understanding of the market. Then the other thing is then, so the next step would be that, okay, this is the problem, and this is my added value to the problem. So you have to say very clearly, you have to be in a position to articulate very clearly what kind of added value I bring to the problem. And the next thing, because that's the next natural question, is why I'm best positioned to solve this problem and not somebody else. So if you are in a position to answer these three questions, be it a fintech or be it a different segment, I think you have you have made, let's say, the first step towards convincing somebody and at least having a successful attempt. And by the way, I think there is a kind of useful rule of thumb to have at the back of our mind, which says that around 5% of startups are going to go to the next round and receive some kind of VC funding, 5%. So identifying this 5% is not the easiest thing to do. So I would say that for me, if I have to kind of, let's say, make an initial judgment around the chances of success for a startup, these three questions and the way that the startup is kind of, let's say, in a position to answer them in a convincing way make a difference.
No, thank you. I think those are relevant questions and something that can, sort of help a startup see where they stand. So yeah, thank you so much. So this is all the questions that we had to discuss. So all in all, for any early stage startup, angel investing is very important. So in summary, so when you are a first-time founder, so it's best to go to your friends and family to raise some money, get to a point where angel investors would show an interest. If you have a product, you have some market validation, and then only angel investors would invest. And it's best to sort of see the angel investors who are active in your geography, because angel investors generally focus on a specific geography. Connect with them on LinkedIn or follow them, see them what they're posting. And you should also be, sort of updating your LinkedIn, for example, on what you all are doing, get others excited. And when you're ready, you can approach the angel investors. So great. So this is all from us. Thank you so much for listening in. And if you have any questions, please post them in the chat and we'd be happy to answer. Thank you.
Thank you.
Thank you so much, Abdullah. I think the questions were really, really insightful. And I believe most of the startups who are attending this call must have gotten some great insights from those questions about at least what to ask to the investors and how they can actually take it forward. Thank you so much, Panagiotis. I'm pretty sure you have almost covered what a startup should look for while they are looking from the angel investment perspective. Thanks once again. So now we would be moving to our last part of the angel investment masterclass. That is the question and answer. I'd like to first thank all the panelists who have already answered a lot of questions which have been asked in the chat window. Request to all the participants who have any questions, we have the floor open. You can type in your questions, and I'm pretty sure someone from the panel would be able to answer you right away. We'll wait for a couple of minutes and then take it forward from there. Mr. Panagiotis, I think we have one question which you might be interested in answering. So Mr. Ali has asked a question around a financial pitch deck. Basically, what are the key metrics that one should include while they are kind of going to any angel investors? And yeah, over to you.
So I think the first one is, first of all, as I said before, and it makes a lot of sense, you need to know your business. So whatever metrics you are going to include, I think it makes sense that you understand them, because there is a tendency that people are searching around and finding all kinds of KPIs and all kinds of metrics, and they try to put everything in one slide, and then most of the times, or quite often, they are not in a position to understand what this means for the business. So I would say that in this case, the less you have, the better it is. So on the one hand side, and on the other hand side, I think you have to kind of, let's say, focus on the basics. And the basics says, I would say, you have to kind of, let's say, have KPIs that are related to the growth and related to the product engagement. I mean, these two KPIs, and I mean, you can have different KPIs in terms of connecting, let's say, to these two big concepts. But I would say for me, these two concepts are important, as well as the market potential. So product engagement, growth, and market potential are kind of, let's say, key for me. And this is going back to kind of being in a position to showcase that you have a good business case and a reasonable horizon over which you can deliver what you are promising.
Great, great. We have another question from Mr. Rahul Yadav. He is asking, I think, so that has already been answered by one of our panelists. There's another question from Mr. Tomek. I think he is trying to understand what kind of range we have in terms of investment from the angel investors. So he's asking, what is the smallest investment that you have seen from the from an individual angel in your career? Over to all the panelists, whoever wants to take it up.
I mean, I can go first, and I can say that normally when you're talking about angel investing, I think the definition is not the definition, but the best practice is starting from 10,000 euros and going up to 100 or 150. And I would say that this is referring to companies or to startups that have an annual or annualized turnover, let's say, up to a couple of million euros, not above, I would say, at the maximum, because then you would kind of have to go to a VC. And what I've seen is that in some cases, there are some angel investors that tend to also have a minimum threshold in terms of turnover.
Got it. There's another question to all the panelists. Basically, what kind of valuation methods are being used and which are being preferred by most of the angel investors these days? I think Mohammed has already answered that question on the chat itself. Thank you, Mohammed. There is another question from Mr. Magnus. He's asking, from the angel investment perspective, do you invest into companies which are pre-revenue? Dr. Tejinder, would you want to take this one?
Yeah, of course, I can do that. I was about to type that. Yes, of course, the startup idea is great and it has a promising market fitment and a future excellent customer adoption. Why not? We should look at pre-revenue, certainly.
Great. So we'll wait for a couple of minutes more. I think we have already answered all the questions that we had from the different participants before concluding the call. I guess we do not have any further questions. So I would like to take this opportunity to thank all the panelists who have taken time out to take this session. And this has been really, really, I think, insightful and interactive as well, given the lot of questions that has been answered on the chat. Thank you once again for coming and joining this session. And thank you to all the participants who have also taking their time out and attended this session. I'm pretty sure that you might have got some really, really good insights from this session. Thank you once more.
Thank you.
Thank you. Thank you.
Thank you, FinTech team. Thank you, everyone.